Joining us now here in our Chicago studio is Zed Francis, the co-founder and CIO of Convexitas. Zed, thanks again for joining us in studio. You know we love having you here in person. I want to dive right into your Q3 note, the Convexitas note, titled Surrender to the Pro-Growth Agenda. Now, what do you mean by that? Who is surrendering? Is it the Fed? Is it the market? Or is it both?
I think it's kind of everybody. I mean, it was a pretty amazing quarter, especially in comparison to Q2, right? We have a little bit of a different dance over the last 3-4 months than we did early in the spring. But a lot of the themes are the old forces kind of surrendering to the current agenda.
And so is this the start of a new cycle then, or are we in like a late stage melt up before something's going to break?
Well, I mean, when you're kind of surrendering that pro-growth agenda, it means all the old items that everybody was worried about, they're at the moment not very worried about it. So you're like, we need something new to raise its head to kind of be a problem. But like you said, the easy one is specifically Powell, but the Fed as a whole kind of surrendered at the Jackson Hole meeting. And the follow through today is that they're continuing on that path. I mean, the only little blurb out of Jay today was essentially that, the whole tapering thing, we're getting close to the end of that. So they're almost leaning into the concept that they are going to be supported. Inflation be damned. We don't even get the numbers anymore at the moment, but let's keep on growing this economy. And you would have thought in that waterfall that bonds, especially longer dated bonds, may have an issue with that. That's in theory going to be the reins on the ability to really lean into growth and to disregard any sort of inflation issues is the concept that the long end bonds would get unhinged, that we have a decent sell-off, that we're back to the 5+% in 10 years. And the opposite has happened. We've had a pretty darn good rally in the long end of the curve, which is allowing everybody to kind of lean in to this concept of, well, growth's going to win out. We're going to be able to grow out of all these potential deficit problems, so on and so forth. So everybody's leaning into growth, and thus far they're surrendering to the concept that it's going to work.
And why do you think that the bond market responded that way? I mean, classically, it's supposed to push yields up, but we saw the converse move happen. Why do you think that is?
So my gut at the end of the day is that positioning is one of the biggest factors. I think a curve steepener was a favorite trade by many, and the main catalyst for making money in a short-term period on the curve steepener was ultimately central banks becoming more accommodative. So you got the catalyst you were looking for, and the results didn't pan out how you would hope. That tends to kind of say, this is overcrowded positioning. And in the short term, it tends to not work when it's overcrowded. The other piece of it is the Treasury has been able to, we'll call it meter their wall of issuance very effectively. They've delayed a lot of issuance items, like right now, the government shutdown, allowing you to go ahead and delay a decent amount of new issuance. And they've kept to the old game plan of the previous Secretary of Treasury, where they've been issuing a significant amount of bills rather than anything longer dated. So I think the ham and egg of active market participants positioning, along with the Treasury is kind of trying to avoid that known tell that things are a problem.
And so if the Fed is really now pro-growth, what happens to inflation expectations next year? I mean, we're all focused on this next meeting, the December meeting. But if that's really the case, what happens next year?
Yeah, again, like by the theme was surrender. Ultimately, I think the market for now is just accepting the concept that 2.5, 3.5 is the new normal. Trying to pin ourselves on 2 is not where we're going to be in the next 1, 3, 5 years. And it hasn't caused any disruption, which always allows people to kind of lean into that further. And ultimately, if markets are going up significantly and wages are going up reasonably well, then a higher inflation isn't going to necessarily disrupt the path that the U.S. economy is on. If we all of a sudden had a 2022 where we have really high inflation and asset prices going down, well, that is a problem for spending, right? But that's not what we have right now. Everything's just kind of happily going up together.
Everybody's happily going up, and everybody's doing a lot of shrugging.
That's right.
A lot of shoulder shrugging. So you've also suggested that Jerome Powell may have signaled some support for Waller as a potential new Fed chair here. What would be the implications if that's actually the case?
I think what the committee is potentially trying to say is, all right, we know you're going to pick somebody new that's likely going to be somebody that tilts towards your camp and thinking of where long-term rates should be for the direction of the FOMC. But they also want somebody that they know well, that's kind of coming from inside the house. That's ultimately not very market disruptive if you pick somebody that's already been a long-term participant in the institution rather than an outsider. So I think there was a little bit of the communication of this person is going to give you what you want and is going to be, we'll call it, appreciated by the markets, as you can see the results of asset prices after that kind of indication.
All right, so with all that said, what are some of the principal threats that could derail this pro-growth narrative?
Yeah, so I think the other thing that ultimately surrendered is the concept that there's any risk in the marketplace. So credit spreads are essentially at post-GFC all-time tights. Even where we've been focused on interest rates over the last 5 years pretty intensively, the MOVE index, which is essentially the implied volatility of interest rates, how volatile we think interest rates are going to be going forward, is all the way back to 2021 levels. So there's no risk in rates, is what the market's pricing in. There's no risk in credit. And the equity markets, in terms of Q3, essentially rallied 8% on an 8 volatility. That was in comparison to the craziness that we were experiencing in Q2. And not everybody thinks in sharp terms, but if you just held the S&P 500 in Q3, that's almost a Sharp of 4. So that is incredible returns with almost zero risk. So the whole market has been saying for the last quarter, there is no risk, which ultimately sets yourself up to, okay, it might not take too much to disrupt that apple cart to go from zero to some risk. And the thing that's embedded specifically in equities, which was a story of 2024 as well, is essentially incredibly low correlation, i.e., equities have been able to diversify themselves. So over the last month, the S&P 500 has a realized correlation of 0. Like that is unheard of, that all the constituents of the S&P are moving essentially half up and half down every single day. So the market's grinding higher, but the correlation across everything is so low that it's basically burying a lot of risk in the system, because across all the constituents of the S&P 500, they're moving as if it's a normal market. It's not a highly volatile market. It's not a low volatility market. It's a normal market. But when you staple them all together, because they're moving in different directions, we experience one of the lowest quarters of volatility since 2017, which was the lowest volatility year of all time.
Well, Zed, thank you for walking us through this growth strategy, the surrender to growth that we're seeing in the markets. Certainly an argument to be made that there's been a lot of shrugging off of a lot of data and a lot of numbers. We appreciate you being in here with us in studio. That's Zed Francis, the co-founder and CIO of Convexitas.